Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello friends, welcome to the revision session for Advanced Capital Budgeting Decisions. This is a new chapter that has been introduced in the CA final AFM syllabus. This is one of the major differences between AFM and the SFM, which was there in the old syllabus. Now this particular chapter is nothing new. It is, even though it is a new chapter, a lot of you who would have studied CA Inter under the old syllabus would have already seen already gone through some elements or important elements of this chapter. But even then, what has happened is this particular chapter not only covers elements of CA Intermediate FM where they have this where they have this particular chapter where risk analysis and capital budgeting chapter, from there a lot of elements have been taken. In addition to that, there are some questions in practice manual because this particular chapter was there in the syllabus that was there before 2017. Okay, so this was there in the, not the old, but the old syllabus. Okay, so that particular chapter, some elements of that, or rather large number of elements of that, plus some elements of the CA Intermediate FM chapter risk analysis and capital budgeting, both of them been combined and brought into this chapter called Advanced Capital Budgeting Decisions as part of AFM, which is new syllabus applicable from May 24. Okay, now I am going to do a revision session of this. Some of you would have already enrolled with us, would have already seen the full-fledged videos that I have done. In this particular session, I am going to try and cover in the quickest possible time, but in the most easily understandable manner, and everything about this chapter. Everything about this chapter, basically the formulae, the logics, the kind of questions that are asked. We will go through the questions. In fact, I am actually going to share even my solutions. In fact, the class notes, I will, I am adding them as part of this particular video. You can actually download the class notes from our website. The link is available in the description. You can go there and download, and you can actually go through everything. Okay, so let us start off and briefly, just to give you a context of what are all we are going to cover in this. We are going to cover first, current trends in capital budgeting. So this is broadly a theory topic, but in this inflation, right? This is not a theory topic. There are some practical questions related to it. Then you will have what is the impact of technology, what is the impact of government on capital budgeting decisions. This is more theoretical. You can go through it at your own time, pace, and easily. I am not going to get into theory aspects. I am going to rather cover theory aspects that are relevant to practical questions. Okay, because this is pure theory. I don't want to cover that. Then you will have decision making under certainty, risk, and uncertainty. And then the next aspect that comes, which is linked to this, is how to incorporate risk. How to incorporate risk. So under this particular topic, you will learn what are the ways in which you can measure risk, or how do you incorporate the risk assessment into the capital budgeting decision. So that's also a very interesting aspect. And then you have factors that are affecting the the capital budgeting decisions. What are the internal factors? What are the external factors? And so on and so forth. After this, we have two more aspects which are about optimum replacement cycle. Then you have APV. This is covered in very brief. They have only given what is the formula. It is explained in detail in the International Financial Management chapter. Okay, so this is broadly what we are going to cover. A large portion of this is what you are seeing, this inflation, technology, government, certainty, risk, uncertainty, factors. These are all theory aspects. Now coming to specifically the part from where the practical aspects start. What are the practical aspects that we are looking at? How do you compute something called as CFAT? What is CFAT? CFAT is cash flow after tax. Cash flow after tax. What is cash flow after tax? And this is annual cash flow. When we are talking cash flow after tax, typically we talk about annual cash flow after tax. And this is for 1 year, right? So cash flow after tax is your revenue minus cost, and here costs exclude depreciation, minus depreciation. So this basically is your PBT, correct? Revenue minus cost minus depreciation is PBT, assuming that interest, everything is there, okay, or ignore interest for a moment. This is PBT. So PBT into 1 minus tax, this gives you what? This basically gives you PAT. So this gives you PAT, right? To this PAT, you are adding back depreciation. Why? Because depreciation is a non-cash item. So you are adding back depreciation. Now, can this be seen in some other form? This is also explained in this form. What is this form? You basically are expanding this formula to finally arrive at a more simplified version. What you are doing is R minus C into 1 minus T plus dt. What is dt? This is the tax benefit on account of depreciation. So what you have done here is, you have you have computed revenue minus cost and taken net of tax. So basically this is your operating profits after tax. To that you are adding back the depreciation, the tax impact on depreciation. That's all you are doing. So this formula, this particular formula, you should be very, very thorough, you should remember, you should understand, you should never forget. Because almost everything in this chapter, or rather everything in capital budgeting, is based on this main formula. This is the underlying basic foundation of everything. Okay, once you remember this, almost everything else will become simple. Now, after this comes the inflation part. If you remember, I told you that inflation is the, in this first point of current trends in capital budgeting, inflation is the only one which is basically there is some logical or rather practical way. Inflation is the only thing, and there are some practical questions. Now, what is this whole practical aspect? See, you remember, and I have repeated this multiple times in other chapters also, in my general discussions with students also, interest rates can never be added. So, if let's say, there is an interest rate of 5%, your FD is 5%. Then your, this particular 5% on this, there is a inflation impact of another 5%. So, the total interest rate is not equal to 10%. You cannot do 5 plus 5. What you have to always do is 1 plus 5% into 1 plus 5%. That will give you something. What will it give you? If you compute 1.05 into 1.05 is equal to 1.1025 is 1.1025, which basically, then you subtract 1 again. So, you get 10.25%. You see, the compounding impact of interest on interest, or a rate on a rate, or inflation on interest has to be necessarily accounted for. What is the compounding impact? That 5 on 5 is 0.25, right? So, that 0.25 has to be accounted, which is why interest rates or inflation or nominal, real, whatever you do, you cannot add interest rates. You have to multiply, which is 1 plus 5 into 1 plus 5. What are we talking here in this particular aspect? We are talking about 1 plus nominal is equal to 1 plus real into 1 plus inflation, or this can also be written as 1 plus nominal by 1 plus real is equal to 1 plus inflation, or inflation is equal to 1 plus n by 1 plus r minus 1, or you can also write this as r is equal to 1 plus n by 1 plus I minus 1. So, it is the same thing, right. So, you have to remember that when you are given a nominal rate and you are supposed to find out the real rate, you have to divide it by inflation. If you have given the real rate and you are supposed to find out the nominal rate, you have to multiply the real rate with inflation. This is one very, very important concept. Now, having looked at this, can I show you a problem where we have done this? Because we have done this in the class, right? So, I will take you through my class notes. This class notes is what I am referring to, is easily, freely available to everybody for them to go through. Okay. This is the class notes I was referring to. So, you can come here, and this basically contains everything that I have actually discussed in the class. So, you see this, what are the current trends, inflation, government, technology change, risk, internal, external, how to incorporate risk, APV, optimum replacement cycle, everything we have discussed. Right. Now, you see this inflation. Why is it necessary to factor in inflation? I have explained. And then we have gone to this thing where we looked at a problem where this is properly explained. Yes, determine the NPV of a project with following information, including inflation premium of 10%. So, where the cost of capital includes inflation premium of 10%. So, total cost of capital is 12 and they are including inflation premium of 10%. So, if you look at this particular problem where we have computed the CFAT, revenue minus cost is EBITDA. From EBITDA, you also have a depreciation computation. What you have done, you basically followed this particular formula and you said R minus C, that is your EBITDA into 1 minus tax rate. What is the tax rate here? Tax rate is given as 50%. So, what is the EBITDA we have got? We have got 20,000. So, 20,000 is basically this number. You multiply it by 50% is 1 minus 50%. You get the net of tax. What is the number? 20% into 50% is 10,000. Then to that, you have added the impact of tax saving on account of depreciation. What is the depreciation? We have computed depreciation here. It's a project with 40,000 and 4 years life. So, and the salvage value is 0. So, basically depreciation is 10,000 per annum. So, what we have done here, we have taken the depreciation of 10,000, multiplied it by the tax rate. So, here we are multiplying by tax rate, you are doing 1 minus tax rate. Please do not forget that. So, you multiplied by tax rate, you get basically the value of tax benefit from depreciation. So, this is the cash flow, or rather this is the cash flow after tax. Now, this cash flow, they have said, this cash flow is basically, they have said is real. Have they said it is real? Initial outlay without inflation. You see, annual revenues without inflation, cost without inflation, everything they have said without inflation. So basically that's a real cash flows. To that real cash flow, you are converting it into nominal. How do you convert it into nominal? You multiply it 1 plus 10%, which is basically your inflation rate, and you arrive at nominal cash flows. Once you arrive at nominal cash flows, you are discounting the nominal cash flow with a nominal rate. See, this is one very important aspect. If you have real cash flows, you discount them with the real rate. If you have nominal cash flows, you discount them with the nominal rate. So, irrespective of which way you do, you will get the same answer, provided the information given in the question is sufficient enough for you to compute real rates and nominal rates separately, you will get the same answer. Okay, so in this case, you computed the nominal cash flow, you are discounting it by the nominal rate, and you are getting a project NPV of, or rather present value of inflows. Subtracting the initial cost, you are getting NPV. Now, same way, instead of discounting with nominal rate, if you want to discount it with real rate, what do you do? Again, please note, you cannot subtract 12 minus 10. You have to do 1.12 divided by 1.1, which will give you a rate of 1.82%. So, you take the real cash flows of 15,000, discount it by 1.82%, and then you arrive at a number, and you see, you again do the same process of, take the inflow, total present value of all inflows, subtract the present value of outflow, and then you will basically get the NPV. Now, this NPV, 17,366 in one case and 17,486 in another case, 100 rupees variance because of rounding off. Other than that, there is no other reason. So, you see, either way you do, whether you do real rate discounting or nominal rate discounting, the fact that you have to remember is you should always do the discounting with the rate corresponding to the nature of the cash flow. If the cash flow is nominal, you discount by the nominal rate. If the cash flow is real, you discount by the real rate. Now, in this we have a variety of problems where they give you revenue different growth rate, revenue inflation rates, cost inflation rates, both are independent. If this is the case, then in such kind of scenarios, it may or may not be possible for you to do everything in real. Why can you not do that? Because cash flows, even though you have been given the cash flows which are on real basis and you have been given the inflation rates, your discount rate is going to be what? Capital cost of capital is 10% including inflation premium. So, you cannot find out the real discount rate. Why? Because the inflation rates across various points of time are different. So, for revenues you have a different inflation rate, for costs you have a different inflation rate, and these change by year. So, your discount rate cannot be a single discount rate in real terms. So, your discount rate has to be necessarily a nominal rate. If the discount rate is nominal, then all your cash flows, inflows and outflows both have to be nominal. So, if you take the real cash flows, convert them into nominal by using the inflation rates for cost and inflation, then arrive at nominal nominal net cash flows, discount them by the nominal rate and arrive at the NPV. So, that is how you do solve a problem like this, right? So, it's a fairly simple one. All you have to remember in all these problems is this particular formula: R minus C minus D into 1 minus tax rate plus D, or R minus C into 1 minus D plus DT. The way to remember it is go by first principles, which is revenue minus cost minus depreciation to 1 minus T plus D. Okay, you are adding back the depreciation, which is a non-cash item. That is the easiest way to remember. Okay. Now, after having looked into this, let us go to the second aspect. What is the second aspect? I said decision making and uncertainty, and how to incorporate risk. Decision making under certainty, risk and uncertainty, and how to incorporate these risks. So, if you look at, and I have just made a very simple comparison. Okay, so if you look at here on the screen, this is what students of old syllabus learned as part of risk analysis in capital budgeting chapter in FM under old syllabus in CA Inter. So, they learnt about statistical techniques like probability, standard deviation, coefficient of variation, conventional techniques like RADR, which is risk adjusted discount rate, or certainty equivalent, then other techniques like sensitivity analysis and scenario analysis. As part of new syllabus for CA Final AFM, you are learning everything same, okay. You probably will get slightly tougher problems, but you are learning everything same, but you are learning two new things. What are these two new things? These are simulation analysis and decision tree. These are something that you have to know, and both of these are very interesting, and I actually think that at some point of time you will get a question, probably if not in the first attempt, second attempt at least you will get a question on these two aspects. When I say first attempt, May 24, second attempt means, or second or third is November 24, so on and so forth. I expect one question on any of these simulation analysis or decision tree in the at least in one of the three attempts, first, second or third attempts, May 24, November 24 or May 25. Okay, why? Because it is new. Simple. There's no other logic. It is new and institute would want to test. And please note, in this chapter, there is a good scope for MCQs. Why do you have a good scope for MCQs? Because there are a lot of small concepts. These small concepts can be expanded into a case and then you can be asked a question. See, when you have a very large concept, it may be difficult to split it into a small part and ask a question. But when you have a small concept, very easy to frame questions around it. Okay, so I expect some good MCQ questions also from this. So some of you may or may not be aware, we have launched something called as FinFries. What is FinFries? This capsules, small 1-2 minute capsules where we explain each concept. That concept, please subscribe to our Instagram channel, YouTube channel. We will provide these capsules free of cost to everybody on on our channels. These are basically shorts or reels or videos, 1 to 2 minutes videos, right? So you can actually access these and keep them as a repository where you can actually revise them before exam. Okay, so please do subscribe to our Insta and YouTube channels on social media, various forms of social media. So we will be releasing FinFries for this chapter also. Okay, so now we are going to talk about these various other techniques, statistical techniques, conventional techniques and other techniques on how you measure the particular risk and how you incorporate the risk into the capital budgeting process. Okay. So friends, how do we incorporate risk? So one of the ways in which you incorporate risk is by probability. You attach probability to various cash flows. So let's say in a single year, you can have multiple cash flows, each one with a different probability. So let us take a simple example, and this is what this first formula talks about. First year you can have 10, 20 or 30, and probability of each one of them is 0.5, 0.3 and 0.2. So the probability total adds up to 1. But what is the exact cash flow that you'll have in that particular? It is basically the expected value, which is 10 into 0.5 is 5, 20 into 0.3 is 6, 30 into 0.2 is 6. So the expected cash flow is 6 plus 6 plus 5, which is 17. Right? So this is very simple formula. I mean, you would have learned this in CA Inter, you would have learned this in otherwise also. It's a very simple formula. And what do you do for expected NPV? So if you have, for 1 year, you have such kind of expected cash flows. You can have expected cash flows for 2 years, 3 years, 4 years. So you compute the expected cash flow value for each year and then divide it, or rather compute the present value of all such expected cash flows to arrive at something called as expected NPV. Expected NPV is what? Nothing, very simple. It is simply the present value of all the expected cash flows. And what is expected cash flow? Multiplication of each individual cash flow with respective probability. Please ensure that the total of probability is 1 or 100. If they're given in percentages, it should be 100%. If they're given in decimal numbers, then decimal points, then it should be 1. And you multiply each cash flow with respective probability and total it up, and then you get an expected cash flow. And for all such expected cash flows, you discount them or arrive at their present value, you get the expected NPV. It's a very simple concept. This is what forms the basis. This is what forms the basis for all subsequent discussions. Now, once you get this expected cash flow, what are you supposed to do with it? How will it actually help a student, or how will it actually help someone who's doing the capital budgeting process? So if you look at the capital budgeting process, we discussed, there are 2 things in which you will measure the riskiness, or you will incorporate the riskiness. We said one is probability. There are other ways in which you can actually incorporate the risk or evaluate the risks in the capital budgeting decision, and they are variance, all of you know variance. Variance is equal to sigma square, and standard deviation is this. Okay, these are 2 ways in which you can incorporate, and then you have a method, another method called coefficient of variation. Coefficient of variation is nothing but standard deviation by you see, expected return or expected cash flow. So expected cash flow. So you found out expected cash flow here. Same way you use that as denominator. Standard deviation by expected cash flow will give you coefficient of variation. Why we will do coefficient of variation, we will discuss. I will take you through a problem, very simple problem, nothing fancy. Right. Now, after completing this, what is the formula for variance? When you have simple cash flows, like let us say 1 year 10, let us say you have cash flows which are 10, 11, 12, 13, so on and so forth over 4-5 years. Then you can compute simple variance. What is variance? Variance is sigma x minus x bar whole square by n. Okay, this is variance. However, the problem, or rather the complexity comes in when you have probability. So year 1, you have cash flows 10, 11, 12, 13. The probability is 0.1, 0.2, 0.3, 0.4. Now, how do you compute variance for this? For this is what we use this formula, what I am highlighting here. Sigma NCF minus ENCF whole square into probability. So, you do sigma cash flow of a particular period, which is basically 10 here, minus expected value. What is expected value? 10 into 0.1 is 1. Here it is 2.2, it is 3.6 and it is 5.2. So, expected value will be 5 plus 5, 10, 11, 12. So, you do net cash flow minus 12 into probability. So, what will it be? For each one, you will do 10 minus 12 whole square into 0.1. Then 11 minus 12 whole square into 0.2. Like that, you will compute it for all of them and you arrive at the variance value. So, basically, when you have probability attached to a set of cash flows or probabilities attached to a specific year's cash flows, you can find out the variance of that particular cash flow stream also. Okay, and once you found out the variance, what is standard deviation? Under root of variance is standard deviation. Very, very simple, right? Now, after having seen this, now let us understand, let us actually go through a problem, because it is very difficult for you when I just explain a formula and run away, right? You need to understand what the problem is. So, let us actually go and have a look at a problem. So, as I was saying, we need to look at the important question. So, I will actually note down the question number also. I will tell you. This particular thing is, this is the cyber company, and the cyber company's illustration number 8. Okay, I'll go somewhere and note down all the illustrations. So later on, when you are looking into this particular video, you can, and I'll give the important question numbers as part of the description of the video itself. So you can go and have a look at the questions also. Okay, this is question number 8, and I'm going to note it down somewhere. Question number 8. What I will do is, towards the end of the video, I'll give a list of all these questions in the first page or some page. Okay. So now coming back, yeah. So cyber company, the cost of capital is so and so, and what is this? 2 mutually exclusive projects. Each one is 5 lakhs. Expected life 5 years. Under 3 possibilities, cash flows. Probabilities are given as under, and cost of capital is 7%. Which project should be chosen and why? So it's a fairly simple one. It's not a complex problem, but we it makes sense to actually solve a problem like this so that you are comfortable. Now, in this question, NPV, what is the NPV of both projects? Project A, NPV is 4.1. Okay. Project A, NPV is 11.4, and Project B, NPV is also 11.4. Why? Because the annual cash flow here, what they have got is expected value is is per annum is about 4 lakhs. So same value has come for B also. So the NPV of the project A as well as project B is same, 11.4 lakhs. Now when you have 11.4 lakhs for both of them, how do you take a decision on which project should be chosen? So there comes the issue of your variance or standard deviation. So you compute variance. Variance basically, if you remember, I told you the formula for it is probability multiplied by the cash flow minus the expected cash flow whole square. So you do for first project 6 minus 4, 4 minus 4, 2 minus 4, and then you multiply with respect and whole square and multiply with respect to probabilities and arrive at a standard deviation or variance. Both of them you arrive at 1.54 because standard deviation is just the square root of variance. Same thing you do for the second project also. The project that has a lower standard deviation is the one that will actually is better. Even though both projects have same NPV of 11.4, one has standard deviation of how much? 77,000, other has standard deviation of 1,54,000. So hence it is better to choose the one which has lower standard deviation. So this is a very simple question. See, you see here, I have highlighted here. So you have to choose the one that has lower standard deviation. Now, this is a very simple case. What happens if instead of being 11.4, it is 11.4 and 8.4? See, one of them has lower NPV. And hence low and also lower standard deviation. Other has higher NPV, other higher standard deviation. How do you evaluate a position like this? This is where you come into the concept of coefficient of variation. What is coefficient of variation? It is standard deviation divided by the expected cash flow. So if you come back to this coefficient of variation, what we were discussing, let's say there are two projects, 11.4 and 8.4. Standard deviation is 1 and 0.5. How will you compare? So this is standard deviation, this is expected NPV, and this is NPV. Okay. So now what happens here? You cannot compare this. See, logically you will say, no, choose the one with higher NPV. No, but there may be a case for choosing the lower NPV project. Why? Because what may happen is, this project is getting higher return but at higher risk. Standard deviation denotes risk. This project is giving lower return but at lower risk. But how do you compare, how do you mix risk and return and say, you give a single number? So you say per unit of return, what is the risk that is being taken? Per unit of return. So which is sigma by expected cash flow, which is 1 by 11.4 compared with 0.5 by 8.4. So what is happening here? 1 by 11.4 will give you how much? 1 by 11.4 will give you into 100. Okay, this is one number. Okay, or I will not take into 100. 1 by 11.4 is, let us say, 0.09. 0.5 by 8.4 is how much? 0.06. So here what we can say is, for every single unit of cash flow of project B, okay, this is A, this is B. For every single unit of cash flow of project B, you are having to take a risk of 0.06. Whereas when say unit, it can be lakhs, it can be crores, whatever it is. For 1 lakh of NPV, you are having to take 0.06. For 8.4 lakhs, you will take 0.5. Here for 1 lakh of NPV, you are having to take 0.09 lakhs of risk. For 11.4 lakhs of NPV, you are having to take 1 lakh of risk. So you are converting this risk and reward or risk and return into a single metric, putting the numerator as risk and denominator as reward and trying to arrive at a ratio per unit of return, how much is the risk that you are taking. And then you arrive at something called coefficient of variation, which will help you understand which project is better. Now in this case, which project is better? Project B has lower risk per unit of reward. So this is better. Project A has very much higher, 50% higher risk per unit of reward. So you will, in such kind of scenarios where they specifically say that, considering the risk reward and analyze and tell whether, you should choose project A or project B. Such kind of scenarios, you go ahead with this coefficient of variation. You say, because they are looking at risk reward ratio, hence coefficient of variation is important. Now, after having understood this, we'll go to Hiller's model. But before we go to Hiller's model, let me finish off one small concept which you studied in CA Inter FM. This is called profitability index. What is profitability index? There are cases in this particular study material in our questions where they have asked what is profitability index. All of us have forgotten what is profitability index. It is discounted cash flows by initial outlay. So it is nothing fancy. It is present value of cash inflow divided by investment. That is called as a profitability index. In present value terms, how many times of your initial investment are you recovering? Because investment is usually on day 0, right? By making an investment, how many times of your investment are you recovering in form of present value of cash inflows? That is this particular measure. This question can also be asked. It has been asked in the questions. Now coming to Hiller's model. What is this whole Hiller's model story? This is never, we have heard never. In fact, even the material, they have not gone too much into depth. Okay. So this Hiller's model is something where, in this Hiller's model is something where they ask you specifically, what is the standard deviation about the expected value or standard deviation of the present value of the distribution? What is the standard deviation about the expected value or the standard deviation of the present value of distribution? Okay, so this basically means, see, there is year 1, 2, 3. In year 1, 2, 3, let's say you have 3 probabilities, 12, 10, 11, 10, 12, 13, you have 0.1, 0.3, 0.6. Like that, next year you have 14, 15, 16. For that again there is some probability, then there is some number, some probability. Like that for 3 years, you have 3 different cash flows and each cash flow has different probability. If that is the case, you can find out expected cash flow for a year. You can find out expected NPV by taking the cash inflow, by taking each of the expected cash flow and discounting it by the respective, whatever is the appropriate discount rate. But after you find out expected NPV, if they ask you to find out the standard deviation of this particular cash flows, standard deviation of all this set of cash flows, how do you do it? This is a very interesting question. I will take you to that question. These are questions 14 and 15. Please, I will make a note, question number 8, then I am talking about question number 15. Let me not do both 14 and 15, let me directly go to question 15. What is question 15? Question 15 is about this Shivam Limited, right? Yeah, Shivam Limited. Shivam Limited is considering two mutually exclusive projects A and B. Project A costs 36,000, project B costs 30,000. They've been given below the net NPV probability distribution for each of the projects. Okay, so for both the projects, there is some probability and NPV estimates are given. So, okay, compute the expected net present value of projects A and B, compute the risk attached to each project, a standard deviation of each probability distribution, and compute profitability index. So, let us look at question 14. 14 is a very important question which has this Hiller's method which can be explained better. And 14 question is what project X and project Y, right? Yeah, project X and project Y. So, you see project X has 3 years cash flows. Each year there is a probability of 3 types of cash flows. So, 30.3, 50.4 and 65.3. So, for each year's cash flow there is a probability attached and there are 3 years of cash flows. Same way for project Y, it is throughout the life same cash flow but different probabilities. And first project is for 3 years, second project throughout the life. They have not said which particular how many years is this project, we will evaluate it for 3 years. Now, what is the question? Which project is better based on NPV? Compute the standard deviation of the present value distribution and analyze the inherent risk of the projects. So, first part is what? On NPV, which one is better? What do? You compute the NPV. NPV is simple. You multiply respective probabilities into the cash flow and arrive at the expected cash flow. What do you do after that? You find the expected net present value. What is the net present value? Each year's expected cash flow, multiplied by its present value factor. In this case, it is 10%. You arrive at it. So, when you arrive at an NPV of 37.314. This is for the first project. For second project, it is single cash flow or a single set of probabilities. So, there are no, cash flows are not changing year by year, they are same for every year, okay, but each one has the cash flow has various probabilities. So, you arrive at the various probabilities, then you arrive at cash flow for each year and then you discount it and then you arrive at an NPV. Based on the NPV, project A is 37 whereas project B is 33. However, okay, the first project is better than the second project. Why? Because it has higher NPV. Now, after completing that, the second question, what is the second question? Compute the standard deviation of the present value distribution and analyze the inherent risk of the project. So, here you use this Hiller's model. What is this Hiller's model is, if you look at the first year's first project cash flow, right, you have probabilities, you have years. And each year there are multiple cash flows, each cash flow has multiple probabilities. So, when you have a scenario like this, how do you find out the standard deviation or variance of that particular cash flow, of that particular cash flows of that particular project is given by this formula. And this formula is nothing complicated. This is also a very simple formula. What you do is, for each year you compute the variance of cash flows. How do you compute the variance of cash flow? It is simple. Sigma probability into X, which is basically your cash flow, minus the expected cash flow for that particular, which is probability into cash flow. You do a summation of all probabilities into cash flow, you get the expected cash flow. So, each cash flow minus expected cash flow whole square multiplied by the probability, which is what you have done here. That you do for each years. Okay, that is what you do and you get basically the variance. You get the variance for each year. So, variance for year 1 is 185 and standard deviation is 13. Like that, you compute variance for year 2 and year 3, 95 and 9.7 and 35 and 5.93. Now, you have got the variance for each year, you have got the standard deviation for each year. Now, how do you get the combined variance or standard deviation? That is what is given by the Hiller's method. So, what they do in Hiller's method, when you see these words, standard deviation about the expected value, standard deviation of the present value distribution, when you see these words, you should remember that this is Hiller's method. And Hiller's method is very simple. If the formula appears complex, it is not. What you are basically doing is, the variance, you compute the summation and square root of variances, you take all 3 variances, divide them by or take the present value factors for each year, for each of the variance pertaining to the year to which it belongs. That is, for first year variance, you divide it by 1.1 whole square. Here the 1.1 is because the discount rate is 10%. So, 1.1 whole square. For second year, you take 95 1.1 power 4, then 35 1.1 power 6. Why are you doing this? I explained this because variance is a squaring, the variance is basically squares. So when you are trying to find out the present value of all these variances, you cannot directly take a normal present value, you have to basically square it. Because you cannot directly take a straight away present value, you have to take the squaring of the present value. So present value factor. So which is why you do, instead of by 1.1, 1.2, 1.3, you do 1.1 whole square, 4 and power 6. And then you arrive at a standard deviation, which is 15.43. Say this is for project X. Now for project Y, what do you do? Project Y is very simple, because every year it is going to be the same. Every year it is going to be the same. But even then, the standard deviation and variance are same, but then the present value summation of all the standard deviations for 3 years will be different. So you have to divide variance by 1.1 square, variance by 1.1 power 4, variance by 1.1 power 6 and sum it, and then look at the standard deviation number. So what is the standard deviation? 5.04. What is it for the previous one? 15.43. So when you look at the standard deviation, project X has higher standard deviation. Higher standard deviation means higher risk. Project Y has lower standard deviation. Lower standard deviation means lower risk. So when you look at these two numbers, a management may take a decision. Probably I am okay with a slightly lower NPV, but with a large amount of lower risk. Or you do this coefficient of variation kind of a thing, right? So you can do things like that, and management can take a decision whether they want to follow, choose a project which has higher risk or choose a project which has lower risk. So this is basically Hiller's method, and this is question number 14 what we have solved. And this 14 is from my material, so my compiler what I am giving you. So you can actually look at it and take a prepare using it. This is a very important question. Alright, now let us move to the next concept. So friends, the next concept is something called as RADR and certainty equivalent. What is this? What is this RADR? What is certainty equivalent? RADR is risk adjusted discount rate. So one of the things that you should remember in capital budgeting is you adjust for the risk either in the cash flows or in the discount rate, not in both. Either you take cash flows which are adjusted for risk and take the discount rate which is not adjusted for risk. Or you take simple cash flows that are not adjusted for risk, but adjust the entire risk in the discount rate. Okay, so RADR is basically your risk-free rate plus your market risk premium. So basically it is a risk premium attached to the project. So you take normal cash flows that are unadjusted for risk, where you don't make any plus or minus, there is no probability, nothing attached to that cash flow. You put everything in the discount rate. So discount rate may, instead of being 10%, maybe 14%, 16%, 17%, something like that. Right, so that is first one. Very simple, there is nothing complicated. You just increase the discount rate and compute the NPV, that's all. And certainty equivalent coefficient. What is this whole certainty equivalent coefficient? Certainty equivalent is certain cash flow divided by expected cash flow, risky or expected cash flow. So you have certain cash flow. So let's say there are cash flows which of 10 are certain, whereas there are cash flows which are not certain. So the total cash flow probably is 80, 90 or something like that. So you do 10 by 80 because only 10 is certain. Only 10 is certain. So this, this is very similar to probability. What is 10 by 80? 12.5%. So you multiply this 12.5% with the cash flow value. So when you compute the net present value, so I'll zoom this in. When you compute the net present value, what do? You basically have cash flow for each year. That cash flow for each year you multiply with something called as alpha, and this alpha is basically your certain by uncertain or total expected cash flows, right? So all you do is multiply each year's cash flow with a certainty equivalent, which is almost similar to the probability based method where you multiply with the probability. So there is nothing beyond that. It is a very simple method. There is nothing, no computation. If you want, you can go through illustrations 15, 16 and all to understand these 16, 17 in order to understand this RADR and certainty equivalent methods. There is nothing fancy in that. Okay, now after having looked at this, let us look at something which is very, very important. This is the key in this particular chapter. This is called sensitivity and scenario analysis. Sensitivity analysis and scenario analysis. There are good number of questions on this also. So what is a sensitivity analysis or scenario analysis? See, when there is a capital budgeting decision where you have inflow and there are outflows, a lot of things can change. Everything can change, right? In the inflow, in cash inflow can change. Inflow depends on sales price can change, volume can change, variable cost can change, the units can change, fixed cost can change, then discount rate can change, the investment value can change, the number of years can change. Everything is subject to change. So you evaluate what are all these things which are subject to change. You say, in sensitivity analysis, you say, if one of these factors, keeping everything else constant, everything else, all other factors are constant, that is discount rate is same, sales price is same, everything else is same, I just increase the volume by 10%. What will happen to the NPV? I decrease the volume by 10%. What will happen? When I say volume, sales volume, okay. If I increase the variable cost by 10%, what will happen? Decrease the variable cost by 10%. When I say increase, decrease, you are increasing or decreasing only that factor. Everything else is going to remain constant as it was earlier. So, you try and compute for a plus or minus change of 10%. Now, why is it 10%? Typically, that is what people look at. Unless, in certain cases, the variability is not so high and you want to look at 1%, 2%, 5%, that is okay. But typically, people look at impact on the NPV of a project for a 10% change, plus 10% or minus 10%. This is one way. Second way is what is the change required in that factor, that is what percentage your sales drop or what percentage your sales price drop, so that NPV, which is 100 now, becomes 0. Okay, so the first case is, let us take sales NPV. Sales is 100 rupees. Okay, every year sales is 100 rupees. NPV is, let's say, 50. For a 10% reduction in this 100, what is the impact on NPV? NPV, let's say, falls down by 20%. So, you say sales has 20% sensitivity, sales value has 20% sensitivity, or sales volume, or you can compute for any factor. Other way to look at it is, how much sales drop so that NPV reduces by 100%. So, basically these are two ways in which you can compute. So, and in examination they will specify which method they want you to use. If they have not specified, my general logic is go with this 10% logic, because making change in NPV and is a slightly cumbersome process, unless of course it is a 15-mark question or a 14-mark question, which I don't think happens usually. If it is given as a 4-mark, 5-mark question, and if it is, there are multiple variables that are given, okay, I will explain a problem with, you will understand better. When there are multiple variables that are given for which they want you to compute sensitivity, typically go with 10% change, unless there is only one variable and they have asked you for sensitivity, or there are two variables they have asked you for sensitivity, or there are 2-3 variables but it is a 16-mark question, in which case you have to do the NPV method, which is what is the total change in NP, what is the total change in the sales or volume or variable cost or everything that is required, so that NPV becomes 0. You have to choose the second method only when they ask you, or when the mark question, when it is a 5-mark question with a single variable, or when it is a 16-mark question with 4-5 variables. Otherwise, my suggestion, go with a simple 10% change in each factor. How much will it result in, or what will be the resultant change in NPV because of a 10% change in a single factor value. And also note, we always look at adverse variance. Why adverse variance? Project risk of downside. We are not looking at upside risk, we are looking at downside risk. Okay, so always adverse variance is looked at. So, sales reduction, cost increase, discount rate increase, volume reduction. So, we always look at things where there is a possibility of negative impact on the NPV. Okay, so that is one thing. And scenario analysis. What is scenario analysis? Sensitivity is where you change only one factor at a time, keeping everything else constant. In a scenario, you change multiple factors at a time. Now, they won't ask you to select which factors, they themselves will give you. In very poor case scenario, these 5 factors are like this. In a best case scenario, these 5 factors are like this. Compare this poor case versus best case. So, they will tell you different variables. What is the value of each of these variables under good scenario, bad scenario, ugly scenario, whatever scenario it is. Okay, so these are two things. Sensitivity is one variable at a time, scenario analysis is multiple variables at a time. Now, for this, I will tell you one very, 2 or 3 important questions. These are very important questions. Let us see. So, friends, the questions that are important here are 20, 22 and 25. Okay. These cover a variety of scenarios under your sensitivity and scenario analysis. If you solve these, you will get good clarity of what is supposed to do or what is required to be done. So, let us go to these questions 20, 22 and 25 and see. Question number 20 is, following are the estimates of cash flows and probabilities of new project of 1 Mrs. X Limited. There are 3 probabilities for cash flows, and for various years there are different cash flows. So, I will just actually clean it up quickly. Yeah. So, following are the estimates of cash flows of probability of a new project of X. probability 0.3, 0.5, 0.2, and you have each year, there are varieties of years. For each year, there is a set of cash flows with different probabilities. Now, what are they asking? Required rate of return on the project is 10%. Find out the expected NPV. Okay. Best case and worst case. Now, what is best case and what is worst case? We will see what is best case and worst case. Probability of occurrence of the worst case of the cash flows are perfectly dependent over time and independent over time. Very good question. Standard deviation, coefficient of variation, assuming there are only 3 streams of cash flows which are represented by each column of the table with the given probabilities. Super question. Coefficient of variation of X limited on its average probability, which is in the range of 0.95 to 1 if the coefficient of variation of the probability is found to be less risky than average. Then 100 basis points are deducted from company's cost of capital. Should the project be accepted by X Limited? Wonderful question, wonderful question. So, the way you solve it is, you first take the initial cost. For each year, you compute the cash flows. So, year 1 to 5, what is the cash flow? Arrive at the expected value. Then you take the salvage value, compute the value, whatever expected value that is given. And then you take a present value of cash inflows and cash outflows, and you arrive at the present value of cash flows, which is 4,13,000, which is basically cash inflows. From that, you subtract the present value of cash outflow, which is the initial investment of 4 lakhs, you arrive at 39,000. Then what you do, what is it that they have asked? What are the best case and worst case NPVs? Now, best case is when forget the probabilities. It is when you get the maximum possibility of inflows, right? Because the outflow is not changing. Outflow is 4 lakhs always, but inflows, if you see, come back to the question and see, outflow is 444, whereas inflow is 1, 1.1, 1.2, and salvage value is 2.2, 0.5, and 6.6. 0.2 lakhs, 0.5 lakhs, and 0.6 lakhs. So, what you do is, you take best case and worst case as the cash flows which are best possible cash flows, you take as best case, worst case as worst possible cash flows, and you compute the NPV. You get 2 different NPVs. Now, what you do, this they have asked. After that, what have they said? Probability of occurrence of the worst cash flow, the cash flows are perfectly dependent. So, if the cash flows are perfectly dependent, that is, for year 1, if I have a bad cash flow, year 2 also it will influence that, if year 1 is bad, all years are bad. That is called perfectly dependent. Perfectly independent means if year 1 is bad, year 2 may be bad, may not be bad. Year 2 may be good, average, like that. So, if it is perfectly dependent, then the probability is 0.3, but perfectly independent, then first time probability of getting bad is 0.3, second time probability of getting it is again 0.3 for that year, independent of 0.3 of the previous year. So, you multiply 0.3 into 0.3 into 0.3 like that for over 5 years. So, you will get a value. That is the answer to this very important, good question. Point 4, standard deviation, coefficient of variation, assuming there are 3 streams of cash flow which are represented by each column. See, what is the formula for variance? Sigma pi into x minus x bar whole square. And we have already computed the NPVs for the worst case and best case. You have already computed NPV for worst and best. Also now compute the NPV for most likely, because that is a third case. Why is that required? Because you have to find out what? Standard deviation to coefficient of variation of the entire project. How will you do that? Please note here, in this particular scenario, this is not the standard deviation about the present value of about the expected values, or standard deviation of the present value distribution. They have not said. They have just said standard deviation coefficient of variation among, assuming that there are only 3 streams of cash flows. What do they mean by this? Does Hiller's method have to be used here? Hiller's method has to be used only when they specifically say that find out the standard deviation about the distribution, or standard deviation of the expected value of the present value of the distribution. They use words like that. Here they said standard deviation assuming that there are 3 streams of cash flows. So, what you do is, you compute the expected value. You compute the expected value for each of the cases, scenarios, and you compute a simple standard deviation. You don't overcomplicate it. You don't complicate it over periods of time and all of that. You compute simple standard deviation of all the expected NPVs, expected NPVs you find out the simple standard deviation. So, expected value of one case minus the expected value of one particular scenario minus the expected value of all the 3 scenarios together, which is probability weighted, and same way you do for other 2 cases, and you find out the standard deviation. You get a standard deviation value. What is coefficient of variation? Standard deviation divided by what? By the expected value. So, the expected value is this, expected value is 39,895, standard deviation is 35,803, you divide one by the other. And then what is the last part? Because the coefficient of variation is in this range of 0.89, it is Generally, their coefficient of variation is 0.95 to 1. If it is lower than that, then the risk reduces. So, hence cost of capital reduces. So, because it is less than 0.95, their risk adjusted discount rate, here they are adjusting the risk, is 0.9%. But you see, what did I tell you? You don't adjust risk both in the numerator and denominator, both in the cash flows as well as in the discount rate. But here they have specifically said, which is why we are doing it. So, if you change that to be the scenario, then you will compute for each year what is the likely present value of expected cash flows, which are basically probability weighted, and discount them and arrive at an expected NPV value. Very interesting question, right? Very, very interesting question. So, this is the one question that you should definitely do. Then there is this question number 22. What is 22? 22 is a very interesting question. This is on scenario analysis. Okay, scenario analysis. We have not, this is on scenario, and no, this is on sensitivity. This is on sensitivity. This is a very interesting question. What is this question? XYZ Limited is considering a project for which following estimates are available: cost, sales unit, cost per unit, sales volume, so on and so forth. Discount rates are given. Then you are required to measure the sensitivity of the project in relation to each of the following: sales price, unit cost, sales volume, initial outlay, project time, and taxation may be ignored. So, what you do is, you first find out the normal NPV. How do you find out normal NPV? You basically take sales, cost, contribution, yearly volume, so yearly cash flow. So, by taking this, you take this value and then you get the yearly cash flow. You take that yearly cash flow and you arrive at the present value factors, subtract the investment, you get the NPV. This NPV, you find out the sensitivity. What do you do with sensitivity? Sales price reduces by 10%. So, in the previous working where you computed the annual cash flow, reduce the sales price by 10%. Then you will get different cash flows. Cash flows will change, right? Then you again find out the NPV again. So, for a 10% reduction in sales, the NPV has come down from 3,10,000 to 3,00,000 minus 82,000. 3,10,000 positive to minus 82, which is basically negative. So, it has changed by 3,93,000. So, for a 10% change, it has changed by 126%. And it is always a adverse variance. So, like that you do for each aspect. But please note, there is also a second case where they say at what sales price will NPV be 0. So, what you do is, you take, this is why I am saying this is a tougher method, or this may consume time in exam. Sales price, what is our cash flow formula? Cash flow is sales, total sales price minus your cost multiplied by the volume divided by, that will give you cash flow per year, divided by 1.1, which is basically your discount factor. Right. So, like that you find out. So, you say S minus 40. So, all 3 years initially the S was same. Now, you are changing, making that S as a constant number and creating an equation where you get 2000 S plus so and so on and so forth is equal to 0. So, you find out the value of S. So, basically you have now arrived at a value of S as 55 compared to what was it earlier in the question. They have said the sales price is 60. So, when the sales price falls from 60 to 55, what are you trying to achieve here? You are trying to equate it to 0. Why are you trying to equate it to 0? You are saying that when sales price, at what sales price will my NPV become 0? So, you are arriving at a sales price at which NPV is 0. So, you are finding out that sales price has to fall by just 7.9% for your entire NPV to be wiped off. So, like that you do for unit cost, you do separately for which one? Change in sales volume, you do separately for sales volume and project cost also. So, you do for all of them and then you actually can summarize. The way you can summarize is this is very important. So, for sales price, 10% reduction causes 126% change. How much percent causes 100% change? 7.89. Change in what? Reduction in sales price results in a reduction in the NPV. Like that, for a 10% reduction in cost, 84% of your NPV reduces, whereas for 11% reduction, it becomes 100%. So, that is what you do. You put a table like this. This is required only if it is a very long question or if it is a short question where they give only 1 or 2 variables. Don't do this, entire NPV, at what point will NPV become 0 or shall I do it for a 10% reduction. If they don't mention anything, use for a 10%. If they give a long problem for more marks, then you do it for both the variations. If they specify, do it for 10%, do only for 10%. Unless they specify, do for NPV becoming 0, don't do it. Unless, of course, it is a very longer, more mark question, higher mark question. Okay. So, this is one question. Then we have question number 25. So, let us look at this question number 25. What is this question number 25? Easygoing Company Limited is considering a project with initial investment so and so. Estimated IRR is 16% having life. So, if IRR is 16%, it means at that point NPV is 0. Financial manager has studied the project with sensitivity analysis, informed that annual fixed cost sensitivity is given. Cost of capital sensitivity is 60%. So, for a cost of capital sensitivity, what does it mean? What is cost of capital sensitivity is 60%? For what change is what? We will understand. Other information, PV ratio. What is PV ratio? Contribution ratio is the PV ratio. Variable cost is 60 per unit, annual cash flow 57,500, ignore depreciation, calculate the investment of the project. So, you see, this is a question which is inverted. Very interesting question. I loved actually this question, and if I remember, I told in the class also, they should ask questions and they will probably ask a question like this, which is why I highlighted. It's a very important question, question number 25. I will again write all the important questions there. So, what you do is, in this particular question, IRR is given at 16%. Time is given, fixed cost sensitivity is given, cost of capital sensitivity, contribution ratio, variable cost and annual fixed cost. What is investment? Annual cash flow also they have given. What is the annual cash flow? Annual cash flow 57,500. So, annual cash flow is 57,500 and present value at 16% 5 years, present value annuity factor at 16% 5 years is 3.27. So, if annual cash flow is so much, the outflow also will be equal. The present value of inflow is equal to present value of outflow. So, the present value of all inflows is equal to present value of outflow. Outflow is in year 1. So, you multiply 3.274 into 57,500, you basically get the actual investment made. Which is 1,88,000. Now, what is NPV? NPV is 0 at 16%, but at 10% what is NPV? They have given you some factors. What you do is, they have given you some factors, right? They have given you some discounting factors, but with the discounting factors, what will you do? See, they have given you second number. What is the number they have given? They have given cost of capital sensitivity is 60%. So, cost of capital sensitivity means here they are saying at cost of capital X, NPV is Y. At cost of capital of X plus 60%, NPV is 0. So, sensitivity is 60% means you have to understand this, that at 60% the NPV becomes 0. So, when you increase the cost of capital by 60%, NPV is reducing to 0. That is what they mean when they use the word. What is the exact sentence? Cost of capital, that is discount rate sensitivity is 60%. So, basically if you increase discount rate by 60%, NPV becomes 0. So, if you consider that NPV is 0 when IRR of 16%. So, your cost of capital is 10% because when it increases by 60, which is 10 plus 60%, which is 16%, your NPV is becoming 0. So, your original cost of capital is 10%. So, using that 10% cost of capital, you can work at NPV. How will you work at NPV? You already have the cash inflows. You also have the cash outflow. Cash inflows, you have the actual value. So, that value, you compute the present value at 10% NPV, a 10% present value factor. So, 10% present value factor, you use this present value annuity factor, multiply by 57,500, that gives you the present value of all cash inflows, subtract the original investment, you get the NPV. Okay. Then fixed cost. Fixed cost sensitivity is 7.81. So, for a 7.8415% change in fixed cost, your NPV becomes 0. You have already found out NPV as 29,000. If you increase your fixed cost by 7.8416%, then your NPV becomes 0. But what is the value of fixed cost? Fixed cost is not a 1 year number, it is across the years. So, present value of all the fixed costs at this 10%, present value annuity factor of all fixed costs at 10%. So, you take PVFA of the, of 10% factor, which is 3.791, multiplied by the fixed cost, that you increase by 7.8416%, your NPV becomes 0. So, if this increases by 7.8416%, NPV becomes 0. So, what you do is, you multiply this 3.791x, which is basically your total fixed cost. For that, you increase the 7.8416%. That will result in an NPV reduction of actual NPV value. So, which is what you equate left hand side and right hand side and arrive at the value of X, which is 1 lakh. Compute the estimated annual sales units. So, how can you compute the annual sales units? You have the PV ratio, use the contribution ratio, and you also have the variable cost. No, they have given variable cost something. No, they have given variable cost is 60. So, using that contribution ratio and variable cost, you can arrive at the sales price. Once you arrive at the sales price, you already know what is the contribution per unit. So, contribution per, and you also know fixed cost per unit. You know cash flow for a year, you know fixed cost per year, you know contribution per unit. So, all you need to do is now solve an equation to find out the number of units. Once you solve the number of units, you get something. So, what are the break-even units? So, now you have the entire structure ready. What is break-even? Fixed cost by contribution per unit. Just divide that, you will get the answer. Fixed cost by contribution per unit, you do that, you will get the answer. So, it is a very, very Interesting and very, very important question according to me. You can expect questions like this in the exam. So this is question number 25. Now, after having done this where we have looked at sensitivity analysis, scenario analysis and all that, the next concept is about simulation. Now, this is a very simple concept. There are no questions that are asked from this. Okay. This concept basically, they use this word called Monte Carlo. Monte Carlo simulation. It's a fancy word, that's all. What is Monte Carlo simulation? Basically, you take a model, financial model, or basically you project the cash flows, then you divide the parameters, you divide the inputs that go into this model. What are the inputs? Sales price, units, variable cost, volume, then your fixed cost, all of these. These are multiple things. You divide them into two parts. One part is what you called as parameters, which are under your control. Second part, you divide it into parameters which are not in your control, which are exogenous variables. Exogenous variables means which are not in your control, which are not in the hands of the decision maker, whereas parameters are within your control. And you take these exogenous variables, are stochastic in nature, that is, they can be random. They can be random and there is a probability attached to each one of those. So what you do is you split your model, input variables in your model into two parts, parameters which are in your control, exogenous variables which are not in your control. These exogenous variables are stochastic in nature, that is, they are random and have are probabilistic in nature. And now go to a random number generator, go to Excel and generate a random number. Based on that random number depicts the cumulative probability. That random number gives you the cumulative probability interval within which the value lies. So I'll give you an example. Look at this example. So you choose a random number. So here there are a bunch of random numbers. So you go follow a process. Don't randomize the randomness again. Choose a random number 53,479. So 53,479, the first two digits 53 fall in this probability distribution 35 to 64 in this interval. So for that, what is the probability is 30% and the value is 30. Now what are we talking about? This is the annual cash flow. Annual cash flow is not in your control. Same way, project life is not in your control. You take the next number which is what? 97. So 97 falls in between 95 and 97. The probability is 0.03 and the project life is 9 years. So now at random, you choose a project life and you've chosen an annual cash flow. Based on this, you arrive at the NPV. So you arrive at various NPVs based on various random numbers. You arrive at various random numbers and various NPVs. So what you do is, instead of coming out with a single NPV number, you say, at random I've done this process. I've done this hundreds, thousands, millions of times, which is why you use computers for Monte Carlo simulation. And when I've done this, I've got a probability distribution. So I basically now have a distribution of NPV values. On an average, the NPV lies here, but the NPV can become less, become more. This is sort of like a normal distribution. So with 95% confidence, I can state my NPV is within a range of 1 to 2. Okay, with 99% confidence, I can say my NPV is in the range of -1 to this, let's say this +1. So this -1 to +3. With a 99.99, I can say my NPV is in the range of -3 to +5. So something like that. I'm just making up numbers. So instead of taking a single number, you come up with a range of values. This is all there is to this simulation exercise. After having understood about simulation, let us look at something called as decision tree. Now decision tree also, we have got a good question. Question number 31. Question number 31, you solve this as well. We will come to that. I will show you the question. Basically what you do is, in a decision tree, 31 and 32 also. 32 also is a good question. 31 and 32. We'll look at 32. I will not solve 31. 32 is a more complicated one, so I'll solve it, or I will show you the solution. What you do is, every point, or when you start a project, there is this square box is a decision node. You take a decision, yes or no. Then when you do that, you get an outcome. That outcome, there are probabilities. It can be good, bad, ugly. For that outcomes, basically there are chance nodes which are depicted by circles. So let's say you do a project, don't do a project. If you do a project, the project succeed. If you do a project, this is the project, when you've taken a chance of doing a project, this is what happens. In that, it may succeed, it may not succeed, it may partially succeed, like that. So there is, square is a decision node and a round or a circle is a chance node, and each of these X, Y, Z are possible outcomes. Now, When in this one thing you should remember, you always move from right to left. You don't move from left to right. I will explain that to you when I look at question number 32, because you will understand that better. You always move from right to left. Let us look at this decision tree analysis, where you start a project, you look at it till the end, but then the analysis happens from end to the beginning and not beginning to end. I will take you through what I mean. Yeah, let us look at this question. A firm has investment proposal requiring an outlay of 80,000. The investment proposal is expected to have 2 years economic life with no salvage value. In year 1, there is a 0.4 probability that cash flow after tax will be 50,000 and 0.6 that cash flow will be 60, and 0.6 probability that it will be 60,000. The probability assigned to each cash flow after tax for year 2 is as follows. Year 1 cash flow is 50 or 60. Year 2 is there are multiple probabilities. Okay. Now, the firm uses 10% discount rate, construct a decision tree for the proposed investment and calculate the expected NPV. What NPV will the project yield if the worst outcome is realized? What is the probability of occurrence of this NPV? What will be the best outcome and what will be the probability of occurrence? Will the project be accepted? And they've given discount factors. So, what we should do in a scenario like this is, you invest 80k, there is 0.4 that it is going to be 50k, there is 0.6 that is going to be 60k. From 50k, after end of year 1, what did they say? End of year 1, and there is no salvage value. In year 2, there is 0.2 that you have cash flow of 24, 0.3 of 32, 0.5 of 44. Same way, 0.4 of 40, 0.5 of 50 and 0.1 of 60. So, you have multiple streams. So, you basically have streams like this. So, what you should do is, there is a cash flow 0.2, there is a cash flow 50, there is an investment of 80. So, you work backwards. So, what you do is, for each flow, you compute, first year 50,000, first year cash flow, second year cash flow is 24,000, first year again 50,000 present value, 50,000 present value, second year 32, 44, like that you compute for each stream you compute. Each stream you compute an NPV, and for each stream you compute a joint probability. What is this whole joint probability business? Joint probability is 0.2 into 0.4. 0.3 into 0.4, 0.5 into 0.4, then 0.4 into 0.6, 0.5 into 0.6, 0.1 into 0.6. Like that you keep doing. So, when you do that, you arrive at joint probability. Now, please note the joint probability will not add up to 1. You multiply the joint probability with each of the NPVs, okay, and then you get a expected NPV. This is the expected value. Worst case outcome is when everything is low, that is when you have the lowest NPV, so minus 1178. Worst case is when you have the lowest NPV, which is pertaining to this 1178, which is minus 14,726. Same way, best case is when you get the highest NPV, which is this 24,000. Now, what have they asked? Is the project accepted or not accepted? Because the expected value of NPV is 6,000, which is positive, you should accept the project. Now, you see, this is a question where you've started working back, from back, right? Now, I will go to this other question, what I mentioned, which is 31, right? I will show you what is 31. L&R wishes to deploy new virus cleaner. The cost of pilot project will be 2,40,000. Presently, the chance of product being successfully launched on a commercial scale are 50%. In case it does not succeed, it can invest 20 lakhs to market the product. Such an effort can again generate cash flow after tax of 4 lakhs. Even if commercial launch fails, they can make a smaller investment of 12 lakhs with gaining 1 lakh every year. Evaluate the proposal adopting a decision tree approach and where discount rate is 10%. So, you see, you can either do a pilot where you spend 2.4 or not do a pilot where you spend 0. When you do a pilot, you have a chance node, right? In chance, the pilot phase succeeds or pilot fails. Now, when pilot succeeds, you can invest 20, not invest 20. When the pilot fails, you can invest 12 or you can not invest anything. So, this is two different parts. Pilot phase is separate, marketing phase is separate. And you compute the value at each node, the NPV at each node and discount it backwards. So, here you have 20 is the investment in 4 lakhs per annum perpetuity. So, 4 lakhs by and 10% discount rate. 4 by 10% is 40. 40 minus 20 is 20. So, here the value is 20 and here it is 0. So, the value of this particular node is 20. Same way the value of this particular node is 0. Why? Because when you invest 12 lakhs, you are getting only 10 lakhs. So, you would not invest. So, the value of this particular node is 0. Like that, you work from extreme right and move backwards. When you move backwards, value at node B. Node B is this. Value at node B will be what? 50% chance of success, 50% non-success. When you're not doing success, when not getting success, not invest. So, the chance of making money is 50% into 20 lakhs, which is 10 lakhs. For doing a pilot of 2.4 lakhs, you'll get a 10 lakh sum, where 10 lakhs is the outcome. So, 2.4 investment, 10 lakhs is output, 7.6 is the NPV. When no pilot is done, NPV is 0, so choose the pilot. Okay, I've gone through the question faster, I know, I understand, but I've given all these illustrations as part of the description. Please go and check the PDF link which is there in the description, you will understand it. This is a revision session, so I will do it like this only. Okay, if you want the full thing, please come and join our class, you will understand it more thoroughly, more clearly. Once this decision tree is also done, next we are coming to the last 2-3 concepts. One is replacement decision, then equivalent annual cost. What is this replacement decision? When you have a machine, old machine, new machine story, where old machine needs to be replaced, how do you take a decision? What you do is, you compute present value of a number called B. What is B? First you compute A. What is A? A is book value of old machine minus book value of market value of old machine. Basically you are trying to find out if there is any gain which is taxable. Why? Because you are multiplying into tax rate. Is there any tax gain or tax loss? What is tax loss? If your book value is 100 rupees, market value is 1000 rupees, then on what do you have to pay tax? You have to pay tax on that 1000 minus 100, which is 900, you have to pay tax. So that is an outflow. Whereas if book value is 100, market value is only 5, then you will have a tax loss. What is the tax loss? 95 is the total loss. On 95, you will get 30% as loss. So you will compute the tax gain or tax loss. So that is number A. Once you compute the tax gain or tax loss, what you do is you find out the investment in the new machinery and subtract the tax gain. Why tax gain? Because it is an inflow, right? Tax gain is an inflow. So you subtract tax gain, or you add the tax loss and you subtract the value that you are getting from sale of old machine. Okay, don't get confused, don't get confused. Cost of new minus A where A is tax gain. Why tax gain is subtracted? Because it is an inflow. So here new machine is an outflow, right? From outflow you subtract the gains that you are making when on sale of an old machine. Whatever is the tax gain you are getting, that tax gain you are subtracting it from the cost of the old new machine. You are also subtracting the market value of the old machine. You will get the net cash outflow. This is year 1. Typically, in our case, they give us problems with where the cash outflow is only in 1 year. So this is year 1 net cash outflow. This is step 1. After that, step 2, you compute the CFAT per year. What is CFAT per year? Because you have replaced the old machine with the new machine, every year there is change in sales. There is probably higher sales, but there is also probably higher cost, and there is also probably higher depreciation. So what you do, change in sales plus or minus change in cost. Typically it is, when there is cost is typically increase in cost, so you will have a minus only. Minus change in depreciation. What is this whole change in depreciation story? Go back to R minus C minus D into 1 minus T plus D. So you are doing change in depreciation into 1 minus T plus change in depreciation. So you are doing the whole thing. Change in sales plus change in cost minus change in depreciation, whole thing into 1 minus T plus change in depreciation. So you are arriving at the change in CFAT. Once you get the change in CFAT, compute the present value of all the changes which you have arrived in step 2, and also do not forget to add the present value of salvage value of the new machine. Once you get this number, this is step 3, you do step 3 minus step 1, value arrived in step 3 minus value arrived in step 1. What is step 1? Step 1 is the actual investment. So our cash outflow minus present value of all inflows, and if outflow, cash inflow minus present value of all outflows. So if inflow is greater than outflows, replace. Inflow is lesser than outflows, don't replace. Okay, this is also it looks as if it's a complicated thing. Actually, my dear friends, trust me, it is not complicated. It is very simple. If you have to just spend 5 minutes understanding this. Okay, now how does this work? What are the questions where this is given? Let us see. Company named RobiCube. So this is question number 33. This also I am noting down. Question number 33. Okay. Decide to replace existing machine. Original cost was so and so. It was installed 5 years ago. Current market value of old is 5,000. Depreciation of old system with 10 years life. Estimated salvage value is nil. Depreciation of new is something. Present value of new is something. Salvage is something. Cost savings is something. Sales is something. There are a bunch of data. Please understand, when so much data is given, you have to draw a table. You have to draw a table both for yourself and the examiner. Both of them. Everybody will require a table to understand what is going on. Okay, original cost, new cost, original life, new machine life, life expected, how much is over, how much is balance, what is the market value today. Everything you make a very, very clear table of what is given. Otherwise, it is going to be absolute chaos. You will solve the problem incorrectly. 99% of us, including me, will solve the problem incorrectly if we do not have the data properly. Okay, what you do is book value of old machine. So you basically compute what is the book value. From book value, you compute the, once you compute the book value, you compute the, I said step one. Step one is first you compute the what is the tax savings. Tax savings is, tax benefit is book value minus market value into tax rate. So book value is 12,000, market value is 5,000. So basically you have a tax savings. You don't have to pay tax. So tax savings has to be added. Okay. So cash outflow of the old machine is 50,000, whereas there is a tax saving of 7,000. So you add and arrive at the old, the cash outflow of 42,000. Then annual cash flows. Annual cash flows, you look at changes in annual cash flows, you don't look at initial annual cash flows itself. So increase in sales, how much? What is the savings in costs, how much? What is the change in depreciation? You find that out. Then you compute change in sales minus change in cost minus change in depreciation, or you can do outside, bring depreciation outside and say change in depreciation into T. Please remember, if you follow delta S minus delta cost minus delta D into 1 minus T, then you add directly the delta D. If you don't do this, then you do following, which is you multiply. If you don't have it here, then here it will be plus delta dt. Please do not forget this. Okay, that is what we have done. You got the annual cash flow. From annual cash flow, you compute the present value of annual cash flow, and to add to that, do not forget the present value of salvage. This is the most important thing everybody forgets. Add the present value of salvage value. Once you do that, compute the present value of inflow, present value of outflow, see the difference, decide based on what is good. Okay, this is a very, very important one, and I expect a question on this also to appear in the first 3 or 4 attempts of this new syllabus. Okay, so now after having done this, let us go to the next concept, which is last concept almost, the equivalent annual cost. What is equivalent annual cost? Equivalent annual cost is present value of cash outflow by present value annuity factor. Now, what are we doing in this present value of cash outflow or present value of annuity factor? What are we doing? When we have assets which need to be replaced, and we need to take a decision when they should be replaced. An asset can last for 5 years, another asset can last for 3 years. How do you compare both? How do you compare cost structure of both? You compute equivalent annual cost for both of them. So you compute something called, you compute basically all the outflows. What are all the present value of all the outflows divided by the present value annuity factor. Please do not forget this. This is present value annuity factor. If you make this mistake, gone. Okay. So for this there is a question. I will tell you which question we should look at. There are complicated questions in this also. I would not get into every question. I would suggest question 39 and question 34. So I will write down 34 and 39. There are 1 or 2 complicated questions, I think, which is very twisted, which I actually don't like it. So I think the question number 40 is a very complicated, 40 I think, if I'm not wrong, is a very complicated question. There's one more question which has that bicycles. 37. 37 and 40 are also important, but they're very complicated and very painful. 37 and 40. 37 is definitely complicated. 40, let me just check. Yeah, 40 also there's a convoluted method. So 37 and 40 also you go through, but I will take you through only 34 and 39. I will not go through any other questions because they are the ones which are more reasonable and more likely to come in the exam. Okay, let us go to 34 and 39. 34 and 39, yes. What is 34? 34, the question is a very simple one. X is a taxi operator. Each taxi costs the company 4 lakhs and has useful life of 3 years. Operating cost for 3 years and salvage value is as follows. You are required to determine the optimal replacement period. Very, very simple. What is optimal replacement period? Present value of outflow divided by present value annuity factor. This is cumulative present value. Cumulative present value of all outflows. All outflows. Please note all outflows. So, you compute at the end of every year what is the equivalent annual cost. So, period, if in year 0, year 1, you have what is outflow, what are the, at the end of 1 year if you replace. Why are we saying end of 1 year you replace? Your operating cost is 1.8 lakhs, but if you resell, you are going to get 2,80,000. So, at the end of 1 year you replace, then what is the total cost structure, what is the present value of all cash flows? That you divide by the present value annuity factor cumulative for year 1, till year 1. So, only first year's present value factor will be considered. So, you will get a value of 3,40,000 something. If you replace an end of year 2, you will have to take cash flows of both the years. Your salvage value of year 2 will come in, and then you get a present value cash flow. You divide it by the annuity factor till year 2, you get 3,15,000. Same way you do for till year 3, you get 3,17,000. So, in which of these cases is the cost lowest? 3 lakh 40, 3 lakh 15 or 3 lakh 17. The answer is 3 lakh 15. So, you do this. Now, the reason why you do this by present value annuity factor is the cash flows are present value. You cannot divide them if you have to compare cash flows of two different periods. There is one set of NPV for 5 years, other set for 4 years. What you do is you compute the cumulative cash outflow divide by the present value annuity factor for 5 years. Same thing you do here, they both become comparable. So, this ESE concept is in order to make things comparable. Okay, this is illustration number 34 and then I said illustration number 39. What is this 39? Company has an old machine. This is a good one. Book value 0 and so on and so forth. This is the last question. Company has an old machine having book value of 0 which can be sold for 50,000. Company is thinking of choosing from one of the two. Incur additional cost of 10 lakhs, upgrade the existing machine, replace the machine with a new machine costing 20 lakhs plus installation cost of 50,000. So, 20.5 lakhs. Both of them envisage useful life to be 5 years with salvage value to be nil. The expected after tax profit for the above three alternatives are as under. Directly they have given PAT. Tax rate is 40%. Company follows SLM, depreciation, assume cost of capital so and so. You are required to advise the company as to which alternative is to be adopted. Now, this is a question that can be solved in two methods and I genuinely did not like the material method. I like the simpler method where you compute the NPV. You can also compute incremental NPV, but I preferred doing the normal NPV because it is easy. And as far as examination is concerned, you have to give a decision which is logical. Okay. So, here upgraded machine, you have 5 years of cash flows and 5 years of PAT, 5 years of depreciation, 5 years of CFAT, 5 years of present value factors and you get an NPV. Okay, it's a very simple point. Same way you do for option 2, you have PAT, you have scrap. What is option 2? Replacement. If you replace, there is a scrap value. So, there is a scrap value, then you compute everything, you compute the present value, you subtract the cost, you subtract the original investment made in this and then you arrive at a NPV. You get 16 lakhs NPV. Then you do the old machine, which is you continue with the old machine without doing anything. Now, this is not given in the question. Why is this not given in the question? Because they want you to actually compute the incremental NPV. Whereas I said compute NPV of the old machine simply. So, you will basically get old machine, what are the cash flows, because they themselves have given the old machine cash flows. Old machine cash flows is given. So, they have not asked this in this part 1 and 2, but they have given the cash flow. So, you compute old machine CFAT and you get a NPV value. Now, the simplest way to look at it is what is incremental NPV? Incremental NPV, first year normal NPV is 17 lakhs or first case which is when you replace. First year is when you upgrade. The normal NPV is 17 lakhs whereas if you do not upgrade NPV is 19 lakhs. So, incremental NPV is 17 minus 19 which is minus 2. You replace NPV is 16 lakhs whereas you do continue with normal NPV is 19 lakhs. So, the incremental NPV is minus 3 or minus 2.7. So, what are you supposed to do? Because both of them are giving negative value or negative incremental NPV, continue to retain the existing machine with the existing setup. Right. So, you can do this on incremental basis, you can do this on independent basis, but I find it simpler to understand and do it on normal basis. However, if the question specifically says, please do it on incremental basis, then please follow the incremental basis which is given in the material. Otherwise, follow the method I have given which is very simple, very easy to understand. Okay. So, you do this replacement decisions and this, you do this with incremental cost where feasible or easy. Okay. And equivalent annual cost, I explained to you. Now, coming to the last concept, this is not given in depth, it is just a concept is, they have just made a passing reference. What is adjusted NPV? Adjusted NPV is a method in which adjusted PV, adjusted present value, it is a method in which you compute you evaluate the project by separating the financial decision and investment decision. So, you do not mix the investment and financing. So, what you do is you compute APV by computing the NPV for the base case, which is normal NPV without taking the benefits of any tax savings or debt or anything like that. Basically, tax savings on interest. Basically, if you have debt, you will have interest expense on which there will be a tax saving. You separate the base case NPV, which is basically from arrive at by discounting at unlevered cost of equity. You will understand how it is done, and you compute the NPV of the tax benefit separately, and you add them both. You are basically separating the investment decision and the financing decision. You are separating the impact of the investment decision or the NPV on NPV, the impact of what is coming from the project, what is coming from financing aspect, and you look at them both independently and compute it. Okay, so this is called adjusted present value. We will look at it later. Now, this concludes the revision. One thing I am supposed to do, which I had told you, is give you the list of all the important questions. So, I will put it here only in the first page. Important questions, you can take it from my material compiler, what I have given. Question number 8, then 14, then 22, then 20, then 25, 31, 32, 33, 34, 39, and I said confusing questions are 37 and 40 are confusing. Okay, these are important. I didn't like this 37 and 40 because I solved it in a very convoluted manner. Okay, so these are the important questions which I am highlighting, and these are confusing questions. All other questions in the material everywhere are much simpler and easy. Okay, if you solve this, I am pretty sure how many? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. If you solve these 10 questions, I am pretty sure you are thorough with the entire chapter. Okay, so that concludes the revision of this chapter, Advanced Capital Budgeting Decisions. So, if you've liked this, please click subscribe to our channel, please follow us on various social media platforms, please enroll in our course, please review us, rate us, and please refer us to your friends. Okay, our goal is to help you succeed, and we want as many people as possible to succeed in the exam. Okay, all the very best, and thanks a lot for watching till the end.